Hello everyone, I'm Stuti Agarwal and welcome to Invesfinc Advisors channel. So a lot of my friends have been asking me about how to trade in derivatives and how to go about it. So in this video, I will be talking about setting your foot in derivatives trading. So let's begin. So in Indian markets, you can trade on three types of derivatives. One is equity, then is commodity, and the third one is the currency. So derivatives basically derive its value from the underlying assets. So let's suppose if I'm buying the call or the put option of Reliance, then the value of it would be derived from the stock price of Reliance. So derivatives could be traded through two instruments. One is the futures and the other one is the options. These are traded on the exchange. So options basically consist of call option and a put option. So call option is denoted by CE, which is call option European style, and the put option is denoted by PE, which means put option European style. So, there are two styles of options that are available. So in India, we follow the European style of options. A European style of option basically means that you cannot exercise the contract before its expiration. By exercising, I mean it is meant that the contract cannot be closed before its expiration. So call option basically means that when the stock price is going up, the call option's price would also go up. But when the stock price is falling, the put option's price would go up, and vice versa. So premium of the option is basically derived by three values. One is the intrinsic value, plus the time value, and plus the volatility value. For the intrinsic value is basically calculated as spot price minus the strike price. So over here, I have Bank Nifty price, which is at 35,810. 35,810 over here is considered as the spot price. And over here, I have a contract, which is for Bank Nifty, August expiry, which is this month's end date. And 36,000 is the strike price, and this is a call option. This is priced at 565. So 565 is basically the premium of the contract. So over here, as strike price is more than the spot price, this is a OTM option, which is out of the money. So if option is out of the money, it basically means that so there is like no intrinsic value for this. The premium is only consists of the time value and the volatility value. You can understand more about this from this slide. This is the classification of the types of strike prices. So basically there are three types. First one is out of the money. As I talked about this snapshot, this contract is basically out of the money strike price. So basically at the time of expiration, out of the money contracts expire worthless with a value of 0, as the strike price is more than spot price. So the intrinsic value is not there, and the buyer is basically losing on the time value and the volatility value. It is cheaper than the ITM option, as there is no intrinsic value which is present. ATM option or at the money option. ATM option also expires worthless, as the strike price is equal to the spot price. So if you subtract both of them, the value comes as 0. It is also cheaper than ITM, as there is no intrinsic value which is present. It only consists of the time value and the volatility value. The third one is the in the money option. So in the money option, at the time of expiry, you will get the intrinsic value, which is the spot price minus the strike price. Over here, the strike price is lesser than the spot price, and it is expensive as compared to the other two types of strike prices, which is the OTM and the ATM. Since the intrinsic value is also present along with the time value and the volatility value. So I took this chart from the NSE website. This is called the option chain. Basically, these are the different strike prices at which Nifty is available. And this is the spot price which is given, which is 16 to 40. The one which is highlighted in pink are the ITM options for on the call side. And on the right side, we have the put options. And the one which is highlighted in pink is the in the money options for the put side. So lastly, coming on how do traders profit from? There are two sides of it. Either you can buy the option or you can sell the option. Selling is also known as writing the option. Buyers of the option basically want the option to expire in the money at the time of expiration, because they would be gaining on the intrinsic value of the option. and the sellers of the option want the option to expire worthless and come down to zero. So I want you to remember these 2 points, which is that option buyers have limited losses and unlimited profit, and option sellers have unlimited losses and limited profit. So this is a small example that I've taken. It is based on the snapshot that we saw on the first slide. So as the premium was given as 565 and strike price was the strike price that we bought was 36,000 call for Bank Nifty. You can ignore the spot price right now, which is 35,800. So these are the different scenarios which are given for Bank Nifty's expiration. So if the Bank Nifty expires at 35,100 on the last date, which is on the expiry, so you would be losing 565, which is the premium amount. So as I talked about, that option buyers have limited losses. So the premium amount is the only loss that you would incur and not more than that. So till the point of the strike price that you have, which is of 36,000, you would be losing 565, which is the amount of the premium. Over it, like if you go above it, which is 36,100, you would subtract the premium amount plus the spot price minus the strike price. So this is a golden formula that you should remember, that the spot price minus strike price minus the premium would be your profit or loss. So to come to the break-even point, you want the Bank Nifty 600 points over your strike price, which is that Bank Nifty should expire at 36,600 for you to give a break-even point. So that's it for this video. I hope that you liked it. If you like it, do give it a thumbs up and share it with all your friends. And we would be coming with more such videos for you to understand more about trading and more about investing. So happy investing. Thank you so much.